Have you noticed how the biggest financial disasters never arrive with sirens? They arrive quietly, wrapped in technical language, buried inside bond yields and currency charts no one bothers to read. Let me ask you something uncomfortable. What if the real crisis already started months ago, and most people are still arguing about headlines that no longer matter? 2 months ago, I warned that Japan's debt problem would not stay contained, that it would leak, that it would break portfolios. Most people ignored it. Not because it was wrong, but because it sounded boring. And boring risks are the most dangerous ones. Here is what should scare you. Japan's 30-year bond yield just exploded to levels never seen before. Not tested, not flirted with, exploded. At the same time, the United States Federal Reserve stepped in to support the Japanese yen. Think about how absurd that is for a second. The American government is now actively stabilizing another country's currency. This is not a theory anymore. This is not a what if. This is happening. And when this becomes the new baseline, the dollar does not come out stronger, it comes out weaker. If you have a retirement account, a pension, an index fund, or even a so-called conservative portfolio, you are exposed whether you like it or not. The system is so tightly interconnected that when one pillar shakes, the vibration travels instantly. The carry trade, bond markets, equity valuations, mortgage rates, and currencies are all tied together. Ignore this, and your portfolio absorbs the shock for you. Understand it, and you at least get a chance to protect yourself before things accelerate. Now, let me ground this in reality. Japan is not dealing with a normal debt problem. Japan is dealing with the worst debt crisis of any major economy on Earth. Their debt to GDP ratio is roughly 250%. Put that into personal terms. Imagine earning $50,000 a year and owing $125,000 while pretending interest does not exist. For decades, Japan paid almost nothing on that debt. That illusion just ended. The moment the Bank of Japan stopped pretending rates could stay near zero forever, the entire global structure started to crack. They raised rates to levels not seen since the mid-1990s, abandoned yield control, and quietly shifted from buying bonds to selling them. That single change altered everything, because once free money disappears, leverage becomes poison. And when leverage unwinds, it does not ask for permission. It forces liquidation, everywhere. Here is where most people lose the plot. For more than 3 decades, Japan quietly powered one of the largest financial loopholes in history. Investors could borrow yen at nearly zero cost, convert it into dollars, and buy higher-yielding American assets. That difference, even a few percentage points, became free money at massive scale. This was called the carry trade, and it worked only because Japanese rates stayed artificially suppressed. Once that condition breaks, the trade does not slowly unwind. It snaps. Now ask yourself a simple question. If Japanese bonds are suddenly paying real yields again, why would anyone take currency risk, political risk, and market risk just to earn a fraction more in US Treasuries? They wouldn't. No rational investor would. That means capital that once flowed effortlessly into American debt now has a reason to go home. And when that reversal begins, it does not move in millions. It moves in hundreds of billions. Japan holds roughly $1.2 trillion in US debt. That alone is enormous. But the real danger is leverage layered on top of it. Hedge funds didn't just participate in this trade, they multiplied it. They borrowed, rehypothecated, and levered positions 20 times over because the downside seemed impossible. When yields rise, margin calls arrive. And margin calls force selling, not selectively. Everything gets sold to survive. We already saw a preview. When this mechanism briefly seized up last year, markets reacted violently. Major indexes dropped sharply in days. Bitcoin collapsed more than 20%. Technology stocks sold off hard. That was not fear, that was forced deleveraging. And forced deleveraging is mechanical. It does not care about narratives, optimism, or central bank speeches. It cares about balance sheets and collateral. This is why distance does not protect you. You may not own Japanese bonds. You may not even know what a carry trade is. But if hedge funds are unwinding leveraged positions, they sell what they can, not what they want. That means US equities, tech stocks, real estate exposure, and even assets people assume are unrelated. When liquidity disappears, correlations move toward one. Everything falls together. This is where the danger becomes invisible to most people. In normal times, markets offer a kind of psychological comfort. Stocks fall, bonds rise, risk goes down, safety goes up. That relationship is the foundation of almost every retirement portfolio on the planet. The classic 60-40 allocation depends entirely on that balance. But when government credibility itself comes into question, that relationship breaks. Stocks fall, bonds fall, and suddenly the protection you thought you had simply disappears. This is not theory. This is correlation risk, and it shows up only during real stress. When investors stop trusting sovereign debt as a safe asset, bonds lose the one job they were designed to perform. They stop absorbing shocks and start amplifying them. In that environment, diversification becomes an illusion. You are not spread across assets. You are concentrated in a single risk, systemic confidence. And once that cracks, portfolios get hit from both sides at the same time. If you own broad market indexes, you are heavily exposed whether you realize it or not. You own technology giants. You own banks. You own leverage. Pension funds, retirement accounts, and passive strategies are all built on the assumption that liquidity will always be there. But liquidity is not guaranteed. When large players are forced to sell, prices do not adjust smoothly. They gap. And when they gap, losses compound faster than most people can react. Now add the banking system into the mix. Banks are massive holders of bonds. Rising yields mean falling bond prices, which directly hit balance sheets. At the same time, higher rates strain borrowers, increase defaults, and tighten credit conditions. That combination is toxic. It squeezes profitability while increasing risk. This is how financial stress migrates from markets into the real economy, quietly at first, then all at once. And here is the part few want to hear. You do not need a collapse for this to hurt you. You only need volatility and forced repositioning. When leverage unwinds, even healthy assets get dragged down. That is why people feel blindsided. Nothing looks broken on the surface. Earnings still exist. Companies still operate. But underneath, the plumbing is failing. And plumbing failures do not announce themselves until the damage is already done. This is where the situation stops being purely financial and turns deeply political. Europe is the quiet pressure point no one wants to talk about. European institutions and funds collectively hold roughly $8 trillion in US Treasury exposure. That is more than Japan and China combined. At the same time, Europe is facing massive fiscal strain. Defense spending is rising. Energy costs remain unstable. Growth is weak. And governments are running out of painless options. So ask yourself where that money comes from. Governments can tax, borrow, or sell assets. Raising taxes in a stagnating economy is politically dangerous. Borrowing becomes expensive when yields rise. That leaves asset sales. And one of the largest, most liquid assets Europe holds is US government debt. Selling treasuries helps fund domestic needs, but it pushes American yields higher. That creates a feedback loop neither side wants, yet both are drifting toward. Now zoom out to Washington. When US officials are reduced to publicly hoping that foreign governments will say the right things to calm markets, that is not leadership. That is triage. Words replace policy because policy has become too costly. Rate cuts risk inflation. Intervention risks credibility. Doing nothing risks volatility. So officials talk, they reassure, they delay. And markets eventually realize there is no real plan behind the language. This is how confidence erodes, not in a single dramatic collapse, but through repeated moments where institutions signal uncertainty. Investors do not panic because they are emotional. They panic because they are rational. When decision makers appear boxed in, capital moves preemptively. It looks like speculation from the outside, but internally, it is risk management. Nobody wants to be the last one holding exposure when exits get crowded. And that is the pattern repeating right now. Japan tightens, Europe strains, the United States reassures. Each action makes sense in isolation. Together, they form a system under stress. Global markets are no longer responding to growth or innovation. They are responding to balance sheet survival. And when survival becomes the dominant motive, risk assets reprice fast, brutally, and without apology. Here is the shift most portfolios are not prepared for. For decades, bonds were treated as protection. When things broke, bonds were supposed to rise, stabilize portfolios, and buy time. That assumption only works when governments are trusted borrowers and inflation is controlled. Once debt levels become questionable, bonds lose their defensive role. They stop being shock absorbers and start behaving like risk assets. That is the moment when traditional portfolio construction quietly fails. This is why correlations matter more than headlines. When stocks and bonds move together, diversification disappears. You are no longer hedged. You are doubled down. This is exactly what seasoned investors warn about, because it changes the math entirely. Losses stack instead of offsetting. Volatility becomes structural, and portfolios designed for calm environments suddenly find themselves exposed to risks they were never built to handle. This is also why hard assets start to reassert themselves. Gold and silver are not investments in growth. They are investments in distrust. They perform best when confidence in paper systems erodes. That does not mean they move in straight lines. They fluctuate. They pull back. But structurally, they benefit when currency credibility weakens and real yields struggle to compensate for risk. That is not speculation. That is historical behavior repeating under familiar conditions. Cash, surprisingly, is not the safe haven many assume. Cash only protects purchasing power when inflation is low and currencies are stable. When governments respond to stress with liquidity and monetary expansion, cash becomes a wasting asset. It feels safe because it does not move, but its value erodes quietly. That is why some seasoned bond investors now recommend holding liquidity only temporarily, not as a long-term refuge. The core lesson here is not to panic or chase performance. It is to understand structure. Markets are not reacting to emotion. They are reacting to incentives. When incentives change, capital flows change. And when capital flows change, asset behavior follows. The mistake most people make is reacting after prices move instead of positioning before structures fully unwind. At this stage, the right question is no longer, what do I buy, but what kind of environment am I actually in? When systems transition, strategy matters more than predictions. You do not need perfect timing, you need resilience. That means focusing on assets and sectors that can survive volatility, higher rates, and shrinking liquidity. This is not about being clever. It is about reducing exposure to fragility while the structure resets itself. Defensive positioning is boring by design. Energy, materials, and essential goods tend to hold up better when growth slows and capital tightens. Companies that control pricing power and real assets have an advantage when currencies weaken. Quality matters more than hype. Balance sheets matter more than stories. Businesses that can operate without constant refinancing are the ones that stay standing when credit conditions tighten unexpectedly. Technology deserves nuance. Speculative tech suffers first when liquidity dries up, but high-quality technology does not disappear. Infrastructure, platforms, and companies embedded into daily economic activity tend to adapt. They raise prices, they cut costs, they survive. The mistake is treating all technology as equal. In stressed environments, dispersion increases. Strong companies separate from fragile ones quickly. What you generally want to avoid are areas that rely heavily on cheap financing. Highly leveraged businesses, regional banks exposed to bond losses, and companies with weak cash flow become vulnerable when rates stay elevated longer than expected. These are not moral judgments. They are mechanical outcomes. When refinancing costs rise, business models break. Markets do not forgive that. Above all, resist the urge to react emotionally. Volatility creates urgency, and urgency destroys discipline. The goal is not to guess the next headline. The goal is to align your positioning with the underlying forces driving markets. Once you understand those forces, the noise becomes less intimidating. You stop chasing. You start observing. And that alone puts you ahead of most participants. If you want to stay ahead of this environment, you have to stop watching headlines and start watching signals. Markets move long before narratives catch up. One of the most important signals right now is the US 10-year Treasury yield. It sounds dull, but it tells you almost everything. When that yield pushes decisively above 4.5%, it signals stress in funding, pressure on equities, and higher borrowing costs across the economy. That number is not arbitrary. It is structural. The US 30-year yield matters just as much. When long-term yields move above 5%, it reflects something deeper than inflation fears. It reflects doubts about long-term fiscal discipline. That is when mortgages become expensive regardless of what central banks say. Governments can influence short-term rates. They do not fully control the long end. The bond market does. And the bond market is currently sending warnings, not comfort. Currencies are another critical layer. The dollar-yen exchange rate is not just a forex chart, it is a stress gauge for the global system. When the yen weakens rapidly or becomes unstable, it forces interventions, policy shifts, and capital movements. Those movements spill into equities, commodities, and credit. Currency volatility is often the first visible crack in a deeper structural problem. Confirmation does not arrive all at once. It arrives through alignment. Rising yields, weakening currencies, falling equities, and widening credit spreads together form a pattern. When you see those elements moving in the same direction, you are no longer dealing with noise. You are dealing with regime change. That is the moment when defensive positioning stops being optional and starts being necessary. The hardest part is psychological. Acting before consensus feels uncomfortable. It feels lonely. But consensus always forms after prices move, not before. By the time everyone agrees something is wrong, positioning opportunities are gone. Watching the right signals allows you to think independently, act calmly, and avoid being forced into decisions by volatility instead of strategy. What ultimately separates those who suffer in transitions from those who emerge stronger is not intelligence or access to information. It is posture. Most investors are conditioned to react. They wait for certainty, confirmation, and social proof. By the time those arrive, prices have already adjusted. The damage is done quietly, then explained loudly. Structural shifts do not reward speed. They reward positioning aligned with reality rather than comfort. The mistake many people make is assuming that stability is the default state of markets. It is not. Stability is manufactured through policy, leverage, and confidence. When any of those weaken, volatility is not an anomaly, it is a return to baseline. Understanding this reframes everything. You stop asking when things will go back to normal and start asking what the new normal demands from you mentally and financially. Another common error is overestimating the protection offered by familiar assets. Familiarity feels safe, but it is not safety. Indexes, bonds, and cash worked well in a specific era defined by falling rates and expanding liquidity. That era shaped habits, not laws of nature. When conditions reverse, habits become liabilities. Clinging to them is not discipline. It is inertia disguised as prudence. The investors who navigate periods like this successfully tend to share one trait. They simplify. They focus on balance sheets instead of stories, structure instead of sentiment, and incentives instead of opinions. They accept that some opportunities will be missed and that not every move needs to be optimized. Avoiding catastrophic loss matters more than capturing marginal upside during unstable regimes. Periods like this do not announce their conclusions. They resolve gradually, unevenly, and often in ways that feel unsatisfying to those seeking clean endings. What matters is not predicting the final outcome, but remaining flexible while the system recalibrates itself. Those who understand the forces at work do not need certainty. They need awareness. and awareness, quietly applied, is often enough.